Volumes and trends. What is volume? Volume is the number of shares of stock, bonds, options, or futures contracts traded over a designated period. Advancing volume is the total volume for all stocks increasing in price. Declining volume is the total for all stocks decreasing in price. To remove variability elements, it may be advisable to smooth this measure with a moving average. Volume reflects the intensity of a stock, commodity, or index. Volume also provides an indication of the quality of a price trend and the liquidity of a security or commodity. What volume reveals about the market's strength? High volume means greater reliance can be placed on the movement in price than if there was low volume, because heavy volume is the relative consensus of a large number of participants. High volume indicates an active market. In an active market, the spread between bid and ask price is usually narrower. High volume is often characteristic of the initial stage in a new trend, such as a breakout in a trading range. Before a market bottom, investor nervousness leads to panic selling, a characteristic of which is high volume. High volume is also attributable to a market top when a strong enough buyer interest exists. Low volume often exists during an unsettlement period, such as at a market bottom. Low volume reflects a lack of confidence that is usually indicative of a consolidation period when the prices are within a sideways trading range. A sizable increase in volume may point to a breakout or climax of a move, which may be temporary or final. In a rare case, it may represent a shakeout. Volume typically follows a trend, expanding on rallies and decreasing on reactions. Volume is useful in ascertaining how strong a change in expectations really is. How volume and price moves reveal the market's trend. It is important to look at the relationship between volume and price. A price move up or down, that is on higher volume, is more significant. Therefore, an analysis of the price and volume allows the investor to better interpret the trends in price and any changes thereto. In other words, volume gives an indication of the strength of a move in price. Current trading volume and average trading volume should be compared. Average trading volume typically decreases when a stock is in a downtrend, because investors view negatively a stock declining in price. An increasing price is typically coupled with an increased volume, but the price can decrease without an increase in volume if investors lose interest in the issue. On the other hand, a declining stock price may be coupled with higher volume when, for example, negative news comes out about the company. The significance of a change in volume is related to the associated price trend or pattern. For example, a good time to buy stock is when there are simultaneous price and volume increases. The accompanying table provides general rules for volume analysis. General rules in volume analysis. Volume should be evaluated in appraising market strength or weakness. If volume is increasing, whether prices are going up or down, it is probable that prices will continue their current trend. However, if volume is decreasing, the current trend will probably not continue and a reversal may be imminent. A strong uptrend usually has more volume on the upward legs. Similarly, a strong downtrend will have more volume on the downward legs. After the trend ends, the corrective leg usually has a lower volume. A downtrend may nevertheless be extended whether average trading volume increases, decreases, or is static. Volume is relative in that it usually is greater approaching the top of a bull market than near the bottom of a bear market. Further, trading volume typically increases and continues higher than average in an uptrend, but is below average during a downtrend. Trading volume typically goes up as the price breaks out of the upside of a pattern or formation. In this case, a significant increase in volume is a strong buy signal. However, volume is an indicator of a trend reversal if it goes in a direction contrary to a prevailing trend. Volume price analysis, on-balance volume, upside-downside volume ratio and line, volume up days, volume down days, cumulative volume index, trade volume index, positive volume index, and volume reversal are among the ways volume can be analyzed. What is trend? The trend is the general direction of a market or of the price of a security. In technical analysis, trends are identified by trend lines that connect a series of highs or lows. Most traders trade in the same direction as a trend, while contrarians seek to identify reversals. Trends can also apply to interest rates, bond yields, and other markets where they're characterized by a long-term movement in price or volume. Technical analysis was founded on the premise that securities prices trend over time, which makes identifying the trend one of the most important elements of the practice. Traders can identify the trend using various forms of technical analysis, including both trend lines and technical indicators. For example, trend lines might show the direction of a trend, while the relative strength index is designed to show the strength of a trend at any given point in time. Many traders live by the mantra, "The trend is your friend," with the exception of contrarians that seek to identify reversals. Trends may also be used by investors focused on fundamental analysis, which looks at changes in the revenue, earnings, or other business metrics. For example, fundamental analysts may look for trends in earnings per share and revenue growth. If earnings have grown for the past 4 quarters, this represents a positive trend. However, if earnings have declined for the past 4 quarters, it represents a negative trend. Using trend lines. The most common way to identify trends is using trend lines, which connect a series of highs or lows. Uptrends connect a series of higher lows, creating a key support level for future price movements. Downtrends connect a series of lower highs, creating a key resistance level for future price movements. In addition to support and resistance, these trend lines show the overall direction of the trend. This example shows a bullish trend line, along with an RSI reading that suggests a strong trend. As the trend began to lose strength, with the falling RSI reading, traders may have started to exit the stock. The breakdown from the bullish uptrend represented a potential change in the longer-term direction of the trend. Trend traders that were long in the security may have sold their shares and waited for a better entry point, while contrarian traders may have looked to inflate a long position after the stock had fallen and the RSI had bottomed out. Uptrend. An uptrend describes the price movement of a financial asset when the overall direction is upward. In an uptrend, each successive peak and trough is higher than the ones found earlier in the trend. In the example shown, notice how each successive high and low is located above the previous one. For example, the high at point 4 is above the high at point 2, and the low at point 5 is above the low at point 3. The uptrend is broken if the next low on the chart falls below 5. The opposite of an uptrend is a downtrend. An uptrend provides investors with an opportunity to profit from a security until it reverses. Selling a security once it has failed to create a higher peak and trough is one of the most effective ways to avoid large losses that can result from a change in trend. Many technical traders also draw trend lines to identify an uptrend and spot possible trend reversals. Moving averages are another popular tool used to determine if a security is in an uptrend. Traders look for prices to be trading above the moving average and for it to be rising. Measuring the strength of a trend can be achieved by using the average directional index indicator. Readings between 25 and 50 indicate a strong uptrend is in place, while readings under 25 tell traders that a security is range-bound. Investors who trade uptrends may be referred to as trend followers or momentum traders. Entering an uptrend. The best time to enter an uptrend is when price retraces back to a support level. Support can come from a trend line, a moving average, or previous price action. For example, a security might retrace back to its 50-day moving average or a previous swing high. Traders can also use momentum indicators such as the relative strength index and the stochastic oscillator to help determine when an issue may be reaching an oversold level. For instance, a trader may buy a stock if its price returns to an uptrend line and the RSI is below 30. Good entry points in an uptrend should have a confluence of support from multiple indicators. In this example, the retracement to a key support level proves to be an excellent entry point. Support comes from the long-term trend line, the 50-day moving average, and an oversold stochastics reading. What is downtrend? Downtrend is the opposite of uptrend. It describes the price movement of a financial asset when the overall direction is downward. A formal downtrend occurs when each successive peak and trough is lower than the ones found earlier in the trend. Notice how each successive peak and trough is lower than the previous one. For example, the low at point 3 is lower than the low at point 1. The downtrend will be deemed broken once the price closes above the high at point 4. Many traders seek to avoid downtrends because they can drastically affect the value of any investment. A downtrend can last for minutes, days, weeks, months, or even years, so identifying a downtrend early is very important. Once a downtrend has been established, a trader should be very cautious about entering into any new long positions.